All right, fellow yield nerds, thanks a lot for making it this far. You are now on episode 4. We're going to be looking at the yield curve. Just so you understand what it is, it's a fancy term that is thrown around, but we're going to go back to our tomato farm and start from there and build up from there and understand the yield curve. And then we're going to log into a popular brokerage account and we're going to actually buy a couple of treasuries. And then we're going to analyze 4 examples so you can do this without me and you can do this in your spare time. So that is episode 4. Having said that, let's get cracking. The first thing we'll be doing is a review of what we have seen so far, so there is very good continuity. We'll then discuss the yield curve. We're going to buy a treasury on a brokerage and then recap what we learned by having you practice the lessons learned and answering questions and going from there. So the very first thing, if you have caught up until now, you would have seen in episode 3 that we went into the United States Treasury bills at large. We talked about how to go direct, and this time it is time to go through a brokerage. Now, we talked about the top reasons for a brokerage, that you have a market, you can manage more than 10,000 in assets, you can keep many asset classes. We reviewed some of the popular brokerages. And we also talked about the caveats in a brokerage. We talked about the fact that brokerages have fees that you may or may not see. Some brokerages waive commissions when buying treasuries, but you may get harmed when you're going to sell. So realize that, in the treasury direct side of the house, there is no market. You can't really sell. In a brokerage, you can sell, but it still is a marketplace with fees. You also typically do not want to sell before maturity, so think ahead, plan ahead. We'll probably do an episode on how to think about planning your ladders, and I'll give you my 2 cents, and you have to make those decisions yourself, so we'll review that. And be careful about buying above par. In the event that you are holding it on, eventually when the bond matures, you are going to see a loss because you will only get your par value back. So we talked about all of that. So with all that said, let us look at an actual screen. We're going to be seeing Schwab.com. I'm not endorsing them. I'm not recommending them. I use them. And as I indicated earlier, I will be contacting all the other brokerages so I can show you sample screens from them as well. So we are purely here for education. And having said that, let us look under the hood of a treasury bill and look at the yield curve along the way. To look at the yield curve in a more user-friendly manner, you can log into Schwab and you can go to the Research tab. And once you're in Research, you would then click on Bonds and Fixed Income. So log into Schwab, go to Research, and go to Bonds and Fixed Income. Right there at the summary screen, you're going to see the new issues, and you're also going to see the overview. If you were to look at new issues, the United States Treasury is going to auction new bills. They're going to say, hey, we have a new bill. It is going to mature in 3 months. There is another one maturing in 6 months. And you can see how, and let me move this here, you can see how there are many different durations. So that is where if you wanted to construct a ladder from a new issue, you can figure out how to put your portfolio together. More commonly, I would imagine yield nerds are going to buy it from a marketplace where someone else has gone through the market and you are buying it on what is called the secondary market. And so, after we looked at maturity in an auction, I'm actually going to focus the bulk of today on the secondary market. Now, how do you go to the secondary market? Instead of looking at new issues, you would just go into what is called the overview screen. And the overview screen is going to show you the yield curve. And before I dive into the yield curve, I'm going to go back to our lovely tomato farm yet again. You give me $100 up front. I go buy soil. I go put my plants in there. And I tell you, hey, give me 3 months. These tomatoes, they're going to give me yield in 100 days, and then I'm going to start paying you back. And then, I give you my X% in interest. And I ask you to be patient and wait, and I'm harvesting my tomatoes and I'm giving you money as I go along, and that's the general concept. And somewhere along the way, your bond matures. I give you back the original 100 you gave me, and you've been collecting the $2 or whatever interest rate along the way. You may remember that. Well, I'm going to ask you a hypothetical question. Let's say that instead of tomatoes, I wanted to do almonds, or I wanted to do another crop that takes slightly longer than 3 months. I say, hey, you seem like a really nice guy. I'm a very nice guy. You're loaning me money. Can I return the money in 9 months instead of 3 months? Now, are you going to ask for the same $2, or are you going to say, well, if it was 3 months, I had a very good level of comfort. Now that you're asking me for 9 months, I'd like to make a little bit more on interest. I would imagine you would say that. That's a pretty reasonable thing to say. What if I said, well, instead of 9 months, how about a year? Because I really want to go through 2 crops, and I have a hot house, and this is going to take me a year. If you would please trust me. And you're going to tell me, as a reasonable person, well, I guess I'll trust you. You have a pretty good track record, but I no longer need $2. I'm going to need something more than even the 9-month term. And then, I establish a very good track record. I keep paying you your interest on a quarterly basis or semi-annual basis, and we do this a few times. And I come to you and say, I need to expand my operation, and it's a drain on my cash flow if I keep paying you, and I have to return your par value or your $100 in 12 months. I'd like to return it after 18 months so I can buy more crop. And you say, well, Padre, you've built your reputation. I suppose 18 months is okay, but, I need a little bit more on the interest rate. And you would be very, very well within your boundaries if you said an 18-month duration, as it is called, is a different level of risk than a 3-month or a 6-month. And then I say, you seem like a nice guy. Can I give it back to you in 3 years? And some of you may start getting uncomfortable, but I've established a great track record. You should trust me. I would imagine you still want more than your 3-month or 6-month or 9 months. And then I tell you, can I keep it for 5 years and then return your $100? And you start squirming in your seat. And you say, 5 years is a pretty decent amount of time. I guess I'll loan it to you. I need to see how you're operating your tomato farm. And I probably need substantially more than $2. Maybe I need $2.50, $3, something like that. And you work with me. We have this good rapport, and I establish my credibility. And then I say, I'm expanding. I'm going to another town and another town. Can I give you that $100 back in 10 years? What are you going to say? As a reasonable person, you are going to say the difference between 3 months and 10 years is so high that you need to see a very good difference in the interest rate or the coupon payment to trust me for that long. And then I come to you and say, hey, how about 30 years? Some of you here may say, oh, whoa, how old am I going to be in 30 years? And maybe some of you say that's too long a horizon. I don't even want to take a risk that long. Others are going to say, well, I have a family estate. This is for me and my kids and my grandkids. And if based on your track record, if you're going to keep giving me this, whatever it is, amount coupon, I need a very nice premium on the 3-month. And if only you can keep showing me that you have a good track record, I trust you. I'm going to give you that 30-year duration, but you need to give me a very, very good coupon payment, and you need to show me that you're credit worthy. That is what a normal, common person would say. Let's now make the person borrowing the United States government. It's reasonable for you to say that the longer the duration, the more the risk. Uncle Sam says something different. Check it out. Uncle Sam says, hey, if you want to borrow for 3 months, I'll give you a 3.32% return. 6 months, 9 months, up to a year, you can see right here that the coupon rate increases. And then, whoa, look at that. As you hold on, as you loan to Uncle Sam the same amount for a longer duration, Uncle Sam doesn't reward you more. Uncle Sam doesn't even reward you the same amount. Uncle Sam rewards you less. How does that sound to you? How many of you would be willing to go loan to Joe Blow Tomato Farm for 30 years at a lower interest rate than for 2 years? That concept is called yield curve inversion, where illogically the returns for a shorter duration are higher than the returns for a longer duration. And that is in many ways indicative of a downturn in the economy. Said differently, we expect interest rates to fall based on what we see a couple of years out, that the government is saying, I'd rather give you a lower interest rate for the longer term maturity and give you a higher interest rate for the shorter term maturity. And that is reality today. So that peak, which is roughly 4% right now, is at the 1 year mark. If you look past 1 year, you actually make less money than, when I say less money, less of a coupon payment than if you bought a treasury that has a duration less than 1 year. So this screen is what you see in Schwab when you go to the overview of bonds and fixed income, and it shows you how CDs compare with the US Treasury. I'm not going to say too much more. The screen says it all. Treasuries beat CDs hands down until a term of 1 year. However, treasuries are also state and local tax free. So let me repeat that. On even an absolute basis, treasuries beat CDs in return for durations less than a year. But even after a year, depending on where you are with respect to local and state taxes, treasuries will give you a better return than CDs. And I actually did the math for you. Treasuries give you almost 10% more yield on a net after-tax basis compared to CDs, all the way until about 18 months. After that, if you can review the table here on the right-hand side, treasuries still give you a higher net after-tax yield all the way until 5 years. Said differently, if you had $1 to spare to buy a CD, if you bought a treasury, as long as your CD term is less than 5 years, you will have more money in your bank account after taxes if you bought the treasury versus the CD. And the United States government is definitely more creditworthy than any bank in the United States. And there is something for you to take to the bank. Welcome to the Yield and Income News Flash from the multi-Oscar winning, best channel, best narration, best yield, YieldNerd channel. In important news today, the Grand Canyon will be filled and renamed to Grand Canal and will become a highway. O'Hare Airport will start stacking airplanes one on top of the other so they can reduce congestion. OPEC will start buying coal mines in America so they can decrease gas prices. And finally, the government will be abolishing income tax. Well, that is mainly from not yet the Times news, because in the real news flash, turns out taxes are still a real thing, except treasuries are state and local tax exempt. So watch YieldNerd now, subscribe and learn how to accumulate and manage yield. Thank you. So what we are really saying is the best in class, if you look at the yield curve that is presented in the overview of bonds and fixed income, the best in class is the United States Treasury. Even if you were to look at an A-rated corporate bond, which pays 4.2% on an absolute basis, remember that corporate bonds are taxed federally, state, and local, And I just used a very simple arithmetic here. Illinois has a state tax of 6.25% and a maximum state plus local of 8 something percent. And so even if you only netted out state tax, Treasuries still beat corporate bonds. It is better for you to loan to America than a really good credit-worthy corporation, at least as of now. And that is a stunning statistic for you to look at. Let me repeat that again. The United States government is both a better risk and gives you a greater reward than a really good credit-worthy company in the United States now. What does that tell you? What the data says is that if your investment horizon is less than 3 years, and I would imagine a portion of your portfolio has that kind of statistic, your best option today may be a treasury note if that is something that suits your taste and your risk tolerance and it is something you want to do. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.